Chapter 1, Introduction to the Art and Science of Technical Analysis, Learning Objectives. After studying this chapter, you should be able to understand the key concepts underlying technical analysis, identify the different forms of chart analysis, describe the objectives of technical analysis, understand what subjectivity means in technical analysis, recognize the strengths and weaknesses of technical analysis, categorize market participants according to style and time in markets, identify the various styles and approaches in technical analysis. Technical analysis is a fascinating field of study. It is as much science as it is art. Its main strength is that a lot of it is visual, giving practitioners a better feel of the underlying dynamics of the markets. We shall also be looking at the various challenges to technical analysis, their resolution, and how technical analysis affects trading in general. The classification of technical approaches, market participants, and various markets will also be discussed in detail. 1.1 Main objective of technical analysis. It is generally accepted that human beings are born with certain instincts, tempered and molded by evolution via the passing of time. Every human being strives and seeks to fulfill these powerful instinctive forces. 1.28 The three main motivational instincts are 1. The instinct to survive, 2. The instinct for comfort, 3. The instinct to propagate. The instinct to survive is probably the strongest and most overpowering. Survival almost always precedes the need for comfort or to propagate the species. The instinct to survive includes the instinct to stay alive, the instinct to satisfy hunger, the instinct to seek safety, that is, being in a group, herd. The instinct to avoid danger by having natural fears like the fear of fire, loud sounds, heights, etc. This powerful instinct to survive is the main driving force in life for striving to make a profit. But in order to make a profit to ensure continued survival, there must be a positive change in the actual or perceived value of something that we own. This change in value of some variable may be anything that will allow us to profit from change. One very popular and convenient variable of change is price. We can participate in this price change by satisfying a very simple mechanical rule that will ensure profitability every single time, which is to always buy when prices are low and sell when they are higher, popularly referred to as the buy low, sell high principle. See Figure 1.1. Unfortunately, in order to satisfy this simple rule of guaranteed profitability, we need to be able to do more of one thing, which is to be able to determine the direction of price ahead of time in order to know exactly when to buy low and subsequently sell higher. Hence, it is not only the mechanical action of buying low and selling high that counts, but also the timing of the action itself that is critical. This Figure 1.1 The mechanics of profiting from a change. 2.29 introduces an element of chance or probability into an otherwise fairly straightforward mechanical venture. Profitability therefore requires effective and efficient action in two dimensions, that is, price and time. Traders and analysts keep track of this action using a two-dimensional visualization tool, that is, a price-time chart, which tracks price on the vertical axis and time on horizontal axis. In short, the ability to forecast or predict price or market action in a reasonably accurate fashion represents one of the skills that may be critical for longer-term success as a professional trader or analyst. 1.2 Dual function of technical analysis. Technical analysis essentially serves two main functions. 1. For identification, it identifies and describes past and present price action. It serves as a historical record of what has transpired in the markets. It provides a descriptive representation of market action. This allows the market practitioner to observe how the market has performed in the past, which includes its average volatility over a specified period, its highest and lowest historical price extremes, the common areas of consolidation, average duration, and price excursion of trends, the amount of liquidity and participation in the markets, the average degree and frequency of price gapping, the impact of various monetary economic announcements on price, and so on. This information is especially critical prior to any investment or trading decision. 2. For forecasting, once a particular price or market action is identified, the practitioner may now use this information to interpret what the data actually means. Before inferring future price action, this inference about potential price action is wholly based on the assumption that price patterns are repetitive to some reasonable degree and therefore may be used as a basis for price predictions. 1.3 Forecasting price and market action. There are three main approaches to predicting potential future price action or behavior, namely via 1. Fundamental analysis, 2. Technical analysis, 3. See Figure 1.2. Forecasting stock prices using fundamental analysis. One way to gauge the potential price of a stock is by analyzing the company's performance via its financial statements and accounts in order to determine its intrinsic value, or the worth of the security in light of all its holdings, debt, earnings, dividends, income, and balance sheet activity, cash flow, and so on. This accounting information is NOR. 3.30. Figure 1.23 Approaches to price forecasting. Merely represented in ratio form, as in price to earnings (P/E), price to earnings growth, PEG, price to book, price to sales, and debt equity ratios, to name but a few. The logic is that a strongly performing company should continue to perform well into the future and garner more demand from investors excited to participate in the expected capital gains derived from the stock's price and appreciating dividend yields. The price of a stock is expected to rise if there are sufficient buyers, signifying a demand for it. Conversely, the price of a stock is expected to decline if there are sufficient sellers, signifying an oversupply in the stock. Demand is potentially generated if the current stock price is below its estimated intrinsic value, that is, it is currently undervalued or underpriced, whereas supply is created if the current stock price is above its estimated intrinsic value, that is, it is currently overvalued or overpriced. See Figures 1.3 and 1.4 for illustrations of using intrinsic value to forecast potential stock price movements. Figure 1.3 Price forecasting based on intrinsic value of a stock. 4.31. Figure 1.4 Price forecasting based on intrinsic value of a stock. There are various ways to determine the degree of over or undervaluation in a stock, some of which include comparing P/E and earnings per share (EPS) ratios or investigating to what extent a stock is trading at a premium or discount in relation to its net current asset value, debt, and other fundamentals. Fundamental analysis helps provide indications as to which stocks to buy based on prior company performance, that is, over the last accounting period. Some investors resort to more active asset allocation methods to try to time the market for a suitable stock to buy into or get out of, rather than just relying on the traditional buy and hold strategy. They resort to studying broad market factors and sector rotation models in order to buy into the best fundamentally performing stocks within a strengthening industry or sector. This method is popularly termed the top-down approach to investing. A bottom-up approach relies more on a specific company's fundamental performance. A buy-and-hold strategy in today's volatile markets may not represent the most effective way of maximizing returns while minimizing potential risks. As a result, many fundamentalists frequently look to various asset pricing and modern portfolio models like the capital asset pricing model (CAPM) to try to achieve the best balance between risk and expected returns over a risk-free rate along what is called the efficient frontier. One of the problems with fundamental analysis is the credibility, reliability, and accuracy of the accounting practices and financial reporting, which is susceptible to manipulation and false or fraudulent reporting. There are various unscrupulous ways to dress up a poorly performing company or financial institution. A simple Internet search will reveal numerous past and ongoing investigations related to such practices. The other problem is the delay in the financial reporting of a company's current financial state in the market. By the time the next audited report is completed and published, the information is already outdated. It does not furnish timely information to act upon, especially in volatile market environments, and, as a result, does not directly account or adjust for current or sudden developments in the market environment. Nevertheless, fundamental analysis does give valuable information about specific securities and their performances. Its main weaknesses: its inability to provide clear and specific short-term price levels for traders to act on. Therefore, fundamental information is better suited to longer-term investment. 532. Decisions, as opposed to short-term market participation, where short-term price fluctuations and precise market timing may be of lesser importance. Fundamental data, on a broader scale, accounts for the overall underlying economic performance of the markets. Supply and demand reacts to the economic data released at regular intervals, which include interest rate announcements in central bank monetary policy and intervention. One example of how supply and demand in the markets are affected by such factors is the Swiss National Bank's (SNB) decision to maintain a 1.2000 ceiling on the foreign exchanges rate of the EUR/CHF with respect to the Swiss franc. This creates a technical demand for the euro, and a corresponding supply in the CHF around the 1.2000 exchange rate level. Many traders have acted and are still acting on this policy decision to their advantage, buying every time the rate approaches 1.2000, with stops placed at a reasonable distance below this threshold. The integrity of this artificial ceiling remains intact as long as the SNB stands steadfast by their policy decision to uphold the ceiling at all costs. See Figure 1.5. It behooves the analyst and investor to examine the actual decision-making process involved with investing in a stock based on intrinsic value. While it does provide an indication, with all else being equal, of the integrity of a certain stock relative to the universe of stocks available, there is a disruptive behavioral component that affects this process. It is not just the calculated or estimated intrinsic value that is an important element, but also the general perception or future expectation of this value that plays an arguably greater and more significant role in determining the actual share price of a stock. This may explain why shares prices do not always reflect the actual value of a stock. This disagreement between price and value is the result of divergence between the actual intrinsic value and perceived or projected value. Figure 1.5 SNB policy impacting on the value of the CHF. Source: MetaTrader 4. 633. Forecasting stock prices using information. Generally, information may be gleaned from various public sources such as newspaper reports, magazines, online bulletins, and so on, upon which market participants may then formulate an opinion about the market, making their own predictions about potential market action. Unfortunately, such publicly available information usually has little merit when used for forecasting pure poses, as those more privy to non-public material information would have already moved the markets substantially, leaving only an inconsequential amount of action for latecomers to profit from, at the very most. This is where technical analysts have the unfair advantage of observing the markets moving on the charts and immediately taking action, regardless of the cause or reasons why such action exists. They are only interested in the effect such activity has on price. Technical analysts typically do not wait for news to be public knowledge prior to taking action or making a forecast based on a significant price breakout. The use of non-public material information potentially affords insiders substantial financial gain from such knowledge, as the release of critical or highly sensitive company information may cause a substantial change in the company's stock price. Hence, it is no great feat to be able to forecast potential market direction based on such prior knowledge, especially if the non-public material information is highly significant or headline-worthy. Needless to say, insider trading is illegal in the equity markets, but the possibility will always exist that it can occur, and in fact has on many occasions. Unfortunately, in unregulated over-the-counter (OTC) markets, nothing stops brokers from front-running large client orders, which is just another form of insider trading. Forecasting stock prices using technical analysis. Technical analysis is essentially the identification and forecasting of potential market behavior based largely on the action and dynamics of the market itself. The action and dynamics of the market is best captured via price, volume, and open interest action. The charts provide a visual description of what has transpired in the markets, and technical analysts use this past information to infer potential future price action based on the assumption that price patterns tend to repeat or behave in a reasonably reliable and predictable manner. Let us turn our attention to some popular definitions of technical analysis. The following definition of technical analysis tells us that charting is the main tool used to forecast potential future price action. Technical analysis is the study of market action, primarily through the use of charts for the purpose of forecasting future price trends. John Murphy, Technical Analysis of the Financial Markets, NYIF 1999. The next definition of technical analysis tells us that the charting of past information is used to forecast future price action. 734. Technical analysis is the science of recording, usually in graphic form, the actual history of trading, then deducing from that pictured history the probable future trend. Edwards and McGee, Technical Analysis of Stock Trends, AMACOM, 2007. Notice that the last two definitions specifically refer to the forecasting of trend action. It is interesting at this point to draw a parallel here with information used in fundamental analysis. Technical analysis is often criticized for the use of past information as a basis for forecasting future price action, relying on the notion that certain price behaviors tend to repeat. Unfortunately, virtually all forms of forecasting are based on the use of prior or past information, which certainly includes statistical, fundamental, and behavior-based forecasting. Companies employ accounting data from the most recent and even past quarters as a basis for gauging the current value of a stock. In statistics, regression line analysis requires the sampling of past data in order to predict probable future values. Even in behavioral finance, the quantitative measure of the market participants' past actions form the basis for predicting future behavior. The following definition of technical analysis tells us that it is the study of pure market action and not the fundamentals of the instrument itself. It refers to the study of the action of the market itself as opposed to the study of the goods in which the market deals. Edwards and McGee, Technical Analysis of Stock Trends, AMACOM, 2007. This next definition of technical analysis tells us that it is a form of art and its purpose is to identify a trend reversal as early as possible. The art of technical analysis, for it is an art, is to identify a trend reversal at a relatively early stage and ride on that trend until the weight of the evidence shows or proves that the trend has reversed. Martin Pring, Technical Analysis Explained, 4th edition. McGraw-Hill, 2002. The following definition is most relevant in the formulation of trading strategies. It reminds the market participants that nothing is certain and we must weigh our risk and returns. Technical analysis deals in probabilities, never in certainties. Martin Pring, Technical Analysis Explained, 4th edition. McGraw-Hill 2002. The next statement gives a behavioral reason as to why technical analysis. 8.35. Technical analysis is based on the assumption that people will continue to make the same mistakes they have made in the past. Martin Pring, Technical Analysis Explained, 4th edition. McGraw-Hill 2002. This definition by Pring stresses and underscores the point that there is a real reason and explanation as to why past price patterns tend to repeat. The tendency of price to repeat past patterns is mainly attributed to market participants repeating the same behavior, although it is not impossible with sufficient and continuous conscious effort and strength of will. Human beings rarely change their basic behavior, temperament, and deep-rooted biases, especially in relation to their emotional response to fear, greed, hope, anger, and regret when participating in the markets. The following statement about technical analysis explains its effectiveness in timing early entries and exits. Market price tends to lead the known fundamentals. Market price acts as a leading indicator of the fundamentals. John Murphy, Technical Analysis of the Financial Markets. NYIF 1999. This definition by Murphy highlights a very important assumption in technical analysis, which is that price is a reflection of all known information acted upon in the markets. It is the sum of all market participants' trading and investment actions and decisions, including current and future expectations of market action. It also reflects the overall psychology, biases, and beliefs of all market participants. Therefore, the technical analysts believe that the charts tell the whole story and that everything that can or is expected to impact the price has already been discounted. This assumption forms the very basis of technical analysis, and without it technical analysis would be rendered completely pointless. Fundamental versus technically based market timing. Before proceeding any further, it is best to briefly explain the meaning of a few commonly used terms in trading and technical analysis. To go long means to buy to open a new position. To liquidate means to sell to close a position previously held. To go short means to sell to open a new position. To cover means to buy to close a position previously shorted. Both fundamental and technically based market timing aim to satisfy the same basic principle of buying low and selling high. There are four basic scenarios where this may occur. 1. Long at a low price and liquidate at a higher price. 2. Long at a relatively high price and liquidate at an even higher price. 9.36. 3. Short at a high price and cover at a lower price. 4. Short at a relatively low price and cover at an even lower price. Listed below are the sum of the strengths of each approach with respect to timing the markets. Technically based market timing offers the ability to provide precise entry and exit prices, provide the precise time of entry and exit, provide real-time bullish and bearish signals, provide real-time entry and exit price triggers, scale in and out based on significant price levels, time entries and exits based on volatility behavior of the underlying exit extended trends at technically significant price reversal levels, time entries and exits based on market order flow, define percent risk in terms of significant price levels, use volume and open interest analysis to gauge strength of an underlying move in order to time entries and exits, use market breadth and broad market sentiment to gauge the strength of an underlying move in order to time entries and exits, forecast potential peaks for shorting or liquidating positions as well as potential troughs for getting long and covering positions via the use of cycle and seasonality analysis. Fundamentally based market timing offers the ability to gauge undervalued stocks with a potential to appreciate in value, but lacking information regarding the precise price or time to get long or to cover. Gauge overvalued stocks with a risk of depreciating in value, but lacking information regarding the precise price or time to get short or to liquidate. Screen and participate in fundamentally strong stocks in a sector or industry. as part of an active asset allocation or rotation strategy, but lacking information regarding the precise price or time to get along. The fundamentalist versus technical analysts. Listed below are some characteristics of the fundamentalist and technical analyst. The fundamentalist is mainly concerned with intrinsic value, strives to understand the underlying causes for potential market moves, is focused on which company to participate in, can tell you which company to invest in, but cannot tell you the most advantageous moment to start participating in that stock. The technical analyst is mainly concerned with structure and dynamics of market and price action, is more concerned with the effects of potential market moves rather than the cause of them. 1037. Cannot usually determine what the intrinsic value of an asset is or whether it is under or overvalued, but is able to determine precisely when to start participating, purely from the perspective of price performance. Is not concerned with the underlying factors that led to the rise in price. This is irrelevant for all practical purposes, as they believe that price is a reflection of all information available in the markets, and therefore that is all that really matters. In short, from what we have covered so far, we know that technical analysis uses past information, uses charts, identifies past and current price action, forecasts potential future price action based on historical price behavior, especially the start of a new trend. Technical data and information. Technical analysts study market action. Market action itself is mainly comprised of the study of price action, volume action, open interest action, sentiment, market spread, flow of funds. Of all the data the technical analysts employ, price is the most important, followed closely by volume action. Price itself is comprised of an opening, high, low, and closing price, normally referred to as OHLC data. OHLC data normally refers to the daily opening, high, low, and closing prices, but it may be used to denote the OHLC of any bar interval, from 1-minute bars right up to the monthly and yearly bars. 1.4 Classifying technical analysis. Technical analysis may be categorized into 4 distinct branches, that is, classical, statistical, sentiment, and behavioral analysis. Regardless of which branch is employed, all analysis is eventually interpreted via the various behavioral traits, filters, and biases unique to each analyst. Behavioral traits include both the psychological and emotional elements. See Figure 1.6. Classical technical analysis involves the use of the conventional bar chart and Japanese candlestick patterns, oscillator and overlay indicators, as well as market breadth, relative strength, and cycle analysis. Statistical analysis is more quantitative, as opposed to the more qualitative nature of classical technical analysis. 1138. Figure 1.6. The 4 branches of technical analysis. Studies the dispersion, central tendencies, skewness, volatility, regression analysis, hypothesis testing, correlation, covariance, and so on. Sentiment analysis is concerned with the psychology of market participants, which includes their emotions and level of optimism or pessimism in the markets. It studies professional and public opinion via polls and questionnaires, trading and investment decisions via flow of funds in the markets, as well as the positions taken by large institutions and hedgers. Finally, behavioral analysis studies the way market participants react to news, profit and losses, the actions of other market participants, and with their own psychological and emotional biases, preferences, and expectations. Mean reverting versus non-mean reverting approach. The type of technical studies employed also depends on the approach taken by traders and analysts with respect to their personal preferences and biases regarding the action of price in the markets. Basically, traders either adopt a contrarian or a momentum-seeking type approach. Being more contrarian in their approach implies that they do not usually expect the price to traverse large distances. In fact, They are constantly on the lookout for impending reversals in the markets. In essence, they expect price to be more mean reverting, returning to an average price, or balance between supply and demand. Those that adopt the mean reverting AP approach prefer to employ technical studies that help pinpoint levels of overbought and oversold activity, which includes divergence analysis, regression analysis, moving average bands, and Bollinger Bands. They prefer to trade consolidations rather than trend action. They normally buy at support and short at resistance. Limit entry orders are their preferred mode of order entry. Conversely, being more momentum-seeking in their approach implies that they usually expect the price to traverse large distances and for trends to continue to remain intact. They are constantly on the lookout for continuation-type breakouts in the markets. In short, 1239. Figure 1.7 mean reverting versus non-mean reverting approaches. They expect price to be more non-mean reverting, where demand creates further demand and supply creates further supply, both driven by a powerful positive feedback cycle. Those that adopt the non-mean reverting approach prefer to employ technical studies that help pinpoint breakout or trend continuation activity, which includes chart pattern breakouts, moving average breakouts, Darvas-the-Box breakouts, and donkey and channel breakouts. They prefer to trade trends rather than ranging action. They normally short at the breach of support and long at breach of resistance. Stop entry orders are their preferred mode of entry into the markets. See Figure 1.7. Advantages and disadvantages of technical analysis. The advantages of applying technical analysis to the markets are: it is applicable across all markets, instruments, and time frames, where price patterns, oscillators, and overlay indicators are all treated in exactly the same manner. No new learning is required in order to trade new markets or time frames, unlike in fundamental analysis where the analyst must be conversant with the specifics of each stock or market. There is no need to study the fundamentals of the markets traded or analyzed in order to apply technical analysis, since technical analysts believe that all information that impacts or potentially may impact the stock or market is already reflected in the price on the charts. Technical analysis provides a clear visual representation of the behavior of the markets, unlike in fundamental analysis where most of the data is in numerical form. 1340. It provides timely and precise entry and exit price levels, preceded by technical signals indicating potential bullishness or bearishness. It has the ability to also pinpoint potential time of entry via time projection techniques not available to fundamentalists. Fundamental analysis does not provide the exact price or time of entry. It makes the gauging of market risk much easier to visualize. Volatility is more obvious on the charts than it is in numerical form. The concerted effort of market participants acting on significantly clear and obvious price triggers in the markets helps create the reaction required for a more reliable trade. This is the consequence of the self-fulfilling prophecy. The disadvantages of applying technical analysis are: it is subjective in its interpretation. A certain price pattern may be perceived in numerous ways, since every bullish interpretation has an equal and opposite bearish interpretation. All analysis is susceptible to the possibility of interpretational ambiguity. Unfortunately, all manners of interpretation, regardless of the underlying analysis employed, be it fundamental, statistical, or behavioral, are equally subjective in content and form. A basic assumption of technical analysis is that price behavior tends to repeat, making it possible to forecast potential future price action. Unfortunately, this tendency to repeat may be disrupted by unexpected volatility in the markets, caused by geopolitical, economic, or other factors. Popular price patterns may also be distorted by new forms of trade execution that may impact market action, like automated, algorithmic, or high-frequency program trading, where Trades are initiated in the markets based on non-classical patterns. This interferes with the repeatability of classic chart patterns. Charts provide a historical record of price action. It takes practice and experience to be able to identify classical patterns in price. Though this skill can be mastered with enough practice, the art of inferring or forecasting future price action based on past prices is much more difficult to master. The practitioner needs to be intimately familiar with the behavior of price at various time frames and in different markets. Although classical patterns may be applied equally across all markets and time frames equally, there is still an element of uniqueness associated with each market action and time frame. It is argued that all market action is essentially a random walk process, and as such applying technical analysis is pointless, as all chart patterns arise out of pure chance and are of no significance in the markets. One must remember that if this is the case, then all forms of analysis are ineffective, whether fundamental, statistical, or behavioral. Since the market is primarily driven by perception, we know that the random walk process is not a true representation of market action, since market participants react in very specific and predictable ways. Though there is always some element of randomness in the markets caused by the uncoordinated actions of a large number of market 1441 participants, one can always observe the uncanny accuracy with which price tests and reacts at a psychologically significant barriers or prices. It is hard to believe that price action is the result of random acts of buying and selling by market participants, where the participants are totally unencumbered by cost, biases, psychology, or emotion. The strong form of the efficient market hypothesis, EMH, argues that since the markets discount all information, price would have already adjusted to the new information, and any attempt to profit from such information would be futile. This would render the technical analysis of price action pointless, with the only form of market participation being passive investment. But such efficiency would require that all market participants react instantaneously to all new information in a rational manner. This in itself presents an insurmountable challenge to EMH. The truth is that no system comprising disparate parts in physical reality reacts instantaneously with perfect coordination. Hence it is fairly safe to assume that although absolute market efficiency is not attainable, the market does continually adjust to new information, but at a much lower and less efficient rate of data discounting. Therefore, technical analysis remains a valid form of market investigation until the markets attain a state of absolute and perfect efficiency. Another argument against technical analysis is the idea of a self-fulfilling prophecy, SFP. Proponents of the concept contend that prices react to technical signals not because the signals themselves are important or significant, but rather because of the concerted effort of market participants acting on those signals that make it work. This may in fact be advantageous to the market participants. The trick is in knowing which technical signals would be supported by a large concerted action. The logical answer would be to select only the most significantly clear and obvious technical signals in triggers. Of course, one can further argue that such signals, if they appear to be reliable indicators of support and resistance, would begin to attract an increasing number of traders as time passes. This would eventually lead to traders vying with each other for the best and most cost-effective fills. What seems initially like the concerted action of all market participants now turns into competition with each other. Getting late fills would be costly as well as reduce or wipe out any potential for profit. This naturally results in traders attempting to preempt each other for the best fills. Traders start vying for progressively earlier entries as price approaches the targeted entry levels, leading finally to entries that are too distant from the original entry levels, increasing risk and reducing any potential profits. This disruptive feedback cycle eventually erodes the reliability of the signals as price fails to react at the expected technical levels. Price finally begins to react reliably again at the expected technical levels as traders stop preempting each other and abandon or disregard the strategy that produced the signals. The process repeats. Therefore, SFP may result in technical signals evolving in a kind of six-stage duty cycle, where the effects of SFP may be advantageous and desirable to traders in the early stages but eventually result in forcing traders into untenable positions. See Figure 1.8. 15.42. Figure 1.8. The idealized six-stage self-fulfilling prophecy cycle. 1.5. Subjectivity and technical analysis. As with most forms of analysis, technical analysis has both objective and subjective aspects associated with its application. It is objective insofar as the charts represent a historical record of price and market action, but it is subjective when the technical analyst attempts to analyze the data. Analyzing price and market action consists of three main activities, namely 1. Identifying price and indicator patterns. 2. Interpreting the data. 3. Inferring potential future price behavior. Analyzing price and market action is ultimately subjective because all analysis is interpreted through various behavioral traits, filters, and biases unique to each analyst or observer. Behavioral traits include both the psychological and emotional elements. As a consequence, each analyst will possess a slightly different perception of the market and its possible future behavior. Subjectivity in the choice of analysis and technical studies. The sheer number of ways to analyze an individual chart contributes to the overall level of subjectivity associated with each forecast. The problem is twofold. What is the most appropriate form of technical analysis that should be applied to a particular chart? What is the most appropriate choice of indicators to apply to a particular chart? 16.43 or 1.9 A simple price chart. Source: MetaTrader 4. These are the usual questions that plague novices. The following charts depict the various popular forms of analyses that can be applied to a basic chart of price action. The following examples are by no means exhaustive. Figure 1.9 starts off with a plain chart devoid of any form of analysis. The next chart, Figure 1.10, shows the application of basic trendline analysis on the same chart tracking the flow of price action in the market. Figure 1.10 Trendline analysis on the same chart. Source: MetaTrader 4. 17.44. Figure 1.11 Moving average analysis on the same chart. Source: MetaTrader 4. In Figure 1.11, moving average analysis is now employed to track the same flow of price action and to provide potential points of entry as the market rises and falls. Figure 1.12 depicts the application of chart pattern analysis to track and forecast the shorter-term bullish and bearish movements in price. Figure 1.13 is an example of applying two forms of technical analysis, that is, linear regression analysis and divergence analysis, to track and forecast potential market tops and bottoms. Notice that the market top coincided perfectly with the upper band of the linear regression line, with an early bearish signal seen in the form of standard bearish divergence on the commodity channel index (CCI) indicator. Figure 1.12 Chart pattern analysis on the same chart. Source: MetaTrader 4. 18.45. Figure 1.13 Linear regression and divergence analysis on the same chart. Source: Figure 1.14 is an example of applying a couple of additional forms of analysis to the basic linear regression band. In this chart, price action analysis is used in conjunction with volume analysis to forecast a potential top in the market, evidenced by the preceding parabolic move in price that is coupled by a blow-off. In Figure 1.15, volatility band, volume, and overextension analysis are all employed to seek out potential reversals in the market. We observe that price exceeds the upper volatility band, which may potentially be an early indication of price exhaustion, especially since it is accompanied by a significant volume spike. The moving average convergence divergence (MACD) indicator is also seen to be residing at historically overbought levels, which is another potentially bearish indication. Figure 1.14, linear regression and volume analysis on the same chart. Source: MetaTrader 4, 1946. Figure 1.15, volatility band, volume, and overextension analysis on the same chart. Source: MetaTrader 4. As we can see from just a few forms of analyses presented in the preceding charts, there are many ways to view the action of the markets depending on the context of the analysis employed. For example, if the analyst is more interested in viewing and understanding the action of price within the context of overreaction or price exhaustion in the markets, he or she may opt to apply technical studies that track levels or areas of potential overreaction or price exhaustion. Technical studies that tracked such behavior include linear regression bands, Bollinger bands, moving average percentage bands, Keltner and Stark bands, areas of prior support and resistance, and so on. Alternatively, if the analyst is more interested in viewing and understanding the action of price within the context of market momentum, he or she may instead opt to apply breakout analysis of chart patterns, trend lines, moving averages, and so on. As long as the reason for using a particular form of analysis is clear, there should be no confusion as to what the studies are indicating. Contradictory, confirmatory, and complementary signals. There are many instances when two oscillator signals are in clear and direct opposition with each other. This is inevitable, as each oscillator is constructed differently. The mathematics underlying each oscillator varies with the purpose it is designed for, and in most cases, it involves the manipulation of price, volume, and open interest data. A few reasons for conflicting oscillator and indicator signals are: the mathematical construction of each oscillator or indicator is different. Each oscillator or indicator tracks a different time horizon. Two identical oscillators may issue inconsistent readings due to missing data on one of the charting platforms. Two identical oscillators may also issue inconsistent readings due to variations in the accuracy, quality, and type of data available on different charting platforms. 2047. For example, applying an oscillator that uses price, volume, and open interest as part of its calculation will yield inconsistent readings should one of the data be unavailable on the charting platform. The analysts may not be aware of the missing data and struggle to make sense of the inconsistency. The accuracy of the data is also of paramount importance for effective analysis of price and market action. Dropouts in the data as well as the inclusion or exclusion of non-trading days will cause inconsistent readings between charting platforms. There may also be variations in the oscillator readings should volume be replaced with tick volume, sometime also referred to as transaction volume. Tick volume tracks the number of transactions over a specified time interval, irrespective of the size of the transactions. It is also important to note that conflicting signals may not always be in fact conflicting. As pointed out, the time horizons over which each signal is applied may be different. In Figure 1.16 we observe that the CCI readings over the range of prices are markedly different. The 20-period CCI indicates a slightly overbought market, whereas the 100-period CCI suggests that prices are slightly oversold. There is, in fact, no real conflict between the two apparently opposing signals. The indicators are merely pointing out that prices are slightly overbought or overextended in the short term, but over the longer term, prices are in fact slightly oversold, that is, relatively cheap. Therefore, instead of viewing the signals as opposing or contradictory, the astute trader immediately realizes that the most advantageous point for initiating a long entry would be when prices are cheap both in the long and short term. This is easily identified on the charts by looking for oversold readings on both the 20 and Figure 1.16 conflicting signals on the daily Alcoa Inc. chart. Courtesy of StockCharts.com. 21:48. 100-period CCI within the area of consolidation, as indicated at point 1. Therefore, the trader may decide to go long once price penetrates the high of the candlestick indicated on the chart. In this example, we see conflicting signals actually complementing each other and affording the trader an advantageous entry at relatively low prices. The important point to remember is that any form of analysis may be employed, as long as the analyst is intimately familiar with the peculiarities associated with each form of analysis. It is better to be conversant with one form of analysis than to employ a slew of technical approaches without fully grasping the intricacies of each approach. This leads to confusion and ineffective analysis. It must be noted that combining technical studies will frequently result in both confirmatory and contradictory signals, as we have seen, with many of the signals being also complementary as well. Only add studies once the first form of analysis is fully mastered. The practitioner must always remember that no form of analysis is always perfectly representative of the market, and it is inevitable that different forms of analysis will many times lead to conflicting signals. Subjectivity in pattern identification. As mentioned, interpretation and inference of potential future price action based on historical price behavior is essentially an exercise in subjectivity. Each analyst will interpret and infer future price action according to his or her own experience, knowledge, objectives, beliefs, expectations, predilections, emotional makeup, psychological biases, and interests. The identification of price patterns may also present some challenge to the novice practitioner. Occasionally, the markets will conveniently trace out various price patterns that may cause some confusion. Refer to Figure 1.17. Figure 1.17 Conflicting Chart Pattern Signals. 22:49. In this example, we see two chart patterns indicating potentially contradictory signals. The ascending triangle is regarded as a bullish indication, while the complex head and shoulders formation is potentially bearish. Therefore, as price starts to contract, forming a symmetrical triangle, an analyst may be somewhat perplexed at the conflicting signals, being unable to provide or issue a clear forecast as to whether the market is indeed potentially bullish or bearish. One way to resolve this apparent conflict is to first identify the size of each pattern. The sentiment associated with larger patterns or formations will take precedence over that of smaller formations. These larger formations are more representative of the longer-term sentiment, whereas the smaller formations are more indicative of short-term sentiment. Hence, in our example, the bullish sentiment associated with the ascending triangle takes precedence over the bearish sentiment associated with the complex head and shoulders formation. Therefore, until price breaches the complex head and shoulders neckline, the entire formation may be regarded as a potentially bullish pattern. Following this simple rule helps reduce some of the subjectivity involved in reading price and chart formations. Figure 1.18 depicts an idealized scenario where all the chart formations are potentially bearish. There is no conflict in sentiment between these formations, as they are all in perfect agreement. The smaller formations act as additional evidence and add to the overall bearish sentiment. There is also a lesser amount of subjectivity involved when reading the sentiment associated with formations that are in perfect agreement. Nevertheless, it should be noted that although such formations may appear somewhat more straightforward with respect to Figure 1.18 chart pattern with complementary signals 2350, inferring potential future price direction, any upside breakout of the larger descending triangle may well precipitate a vigorous and rapid rally in prices due to the unexpected nature of such a move. Traders must exercise caution, especially when shorting such a formation, as prices can quickly explode to the upside caused by an avalanche of short covering. Interpretational and inferential subjectivity. This element of subjectivity with respect to interpretation and inference is not merely confined to applications in technical analysis. In fact, every form of analysis involves a certain amount of subjectivity and arbitrariness when it comes to its interpretation. For example, let us assume that the price of oil has risen significantly. This event in itself can be interpreted in two different ways. One fundamentalist may strongly believe that this rise in oil prices will impact the markets adversely, as it will raise the underlying cost of commodities, whereas another fundamentalist may strongly believe that the rise in oil prices is a direct result of market demand, a bullish scenario indicating a healthy and growing economy. In another example, a technical analyst may strongly believe that an overbought oscillator reading is a clear indication that the trend is strong with further continuation expected in price, whereas another technical analyst may strongly believe that the overbought signal is a clear indication that the market may be already overextended, and therefore expects a reversal in trend. The beginner quickly realizes, after some reflection, that for every bullish interpretation, there exists an equal and opposite bearish interpretation. This is one of the main reasons why forecasting is regarded as largely subjective. Subjectivity and selective perception. Human bias is another factor that adds to the degree of subjectivity when attempting to interpret technical signals. Chartists will many times ignore signals that conflict with their preconceived ideas of where the markets ought to be at any one time. They only select oscillators and indicator signals that support their analysis of the market. For example, a chartist uses three oscillators, the MACD, Relative Strength Index, RSI, and stochastics. The chartist has a bullish view of the markets and believes that it is about to break to the upside. All of the oscillators have bullish readings except for stochastics. The chartist ignores the stochastics signal because it does not agree with his or her view of the markets. On a subsequent occasion, it is MACD that is not in agreement with the chartist's view, and only the signals from the other two oscillators are heeded. This is known as selective perception. See Figure 1.19. Selective perception adds to the subjectivity of the forecast, as there is no fixed point of reference or basis for making decisions based on evidence. Choosing only signals that agree with one's view will lead to biased and erroneous interpretations and unfounded forecasts. In fact, it is when there are discrepancies in the signals that the chartist gains the most information from the markets, as it may be an indication that there could well be some form of underlying weakness in the markets. 2451. Figure 1.19 Selective perception and conflicting oscillator signals. Subjectivity in determining an event, the point of entry. Identifying, interpreting, and inferring market action are not the only areas where subjectivity plays a significant role. The determination of the exact points of entry to an exit from the market is also subjective at the most fundamental level of observation. What appears to be essentially objective is also built on a foundation of subjectivity. An example will help illustrate the point. Refer to Figure 1.20. Figure 1.20 Example of subjective objectivity, 25.52. Assume that a chartist is interested in identifying a market top via a trend line. Penetration. The chartist locates two significant troughs in an existing uptrend and draws a line connecting the two troughs, projecting that line into the future. Price eventually makes a top in the market and subsequently declines and penetrates the uptrend line, signifying the formation of a market top. This seems to be a totally objective exercise since the uptrend line and the point of penetration were clearly marked and recorded on the charts. Unfortunately, the objectivity ends here. Although each act of identifying the trend reversal was purely objective, the variables upon which the process of identification is based is determined subjectively by each chartist, according to their goals, biases, experience, and preferences. Another chartist could well have drawn a steeper trend line and declared that the penetration of this new trend line marks the true point of reversal in the market. As you can see, although each act of identifying the exact point of reversal is strictly objective in itself, the existence of alternative trend lines introduces an element of subjectivity as to which trendline penetration is the definitive indicator or signifier of the trend reversal. We can find another example of this subjective objectivity. Automated or program trading is usually regarded as a purely objective mode of trading where all the rules of engagement with the market are fully codified and mechanically executed. This removes all subjectivity with respect to the entries and exits. Just as in our previous example, the point of penetration of each trend line was also purely objective. However, should the automated trading software allow for some parameter adjustments, this instantly introduces an element of subjectivity as to which parameter adjustments are the definitive settings for a profitable trading campaign. Therefore, no matter how objective each individual act is, once the possibility of alternative acts exists, the issue of subjectivity arises. In a sense, each determination is individually objective but collectively subjective. The very act of determining the exact entry point to initiate a trade is somewhat subjective. Let us assume that a trader is interested in initiating an entry at the break of an uptrend line. Price initially fails to exceed a previous peak, which is a bearish indication. Price subsequently declines and breaches the uptrend line, and in the process triggers a trade. Some questions that a trader may now ask are: at which point after the breakout do I initiate an entry into the market? What is a reasonable amount of price penetration required before an entry is initiated? Do I wait for the penetration bar to close first, or do I initiate an entry at some arbitrary point during an intraday violation of the trend line? What if the penetration bar closes too far away from the original trend line? Breach. How would I know if the violation is merely a false breakout? Should I allow for a larger penetration before initiating an entry in order to filter out potential false breakouts? If so, how much larger a penetration is required to filter out such breakouts? The answers to all of these questions really depend on the objectives of the trader and what he or she is attempting to achieve. There are essentially two ways. 26.53. Figure 1.21 Subjectivity and the rules of engagement of initiating an entry at the breakout of some price barrier. The first is to initiate an entry at some arbitrary point just after a breakout. The other is to initiate a trade based on some fixed rules of entry and exits. See Figure 1.21. Subjectivity arises not because the rules of engagement are unclear, but rather because of the number of choices available. Hence, each trader will select the rules of entry and exit that suit their personality, risk capacity, or familiarity with a certain mode of engagement. A trader could initiate a trade once price moves a certain distance away from the breakout or once the penetration bar closes. Traders may even choose to enter the market after a certain amount of time has elapsed from a breakout. Figure 1.21 lists three main types of filters that traders frequently use to initiate an entry. Price, time, and algorithmic filters will be discussed in more detail in Chapter 5. Summarizing, even if the rules for identification, interpretation, and inference are rigidly codified, the very fact that we have choice renders the entire analysis subjective from the ground up. Hence the argument that technical analysis is subjective in fact represents a general comment on all forms of analysis. It is not unique to technical analysis. Here is a little exercise in subjectivity associated with pattern recognition. See Figure 1.22. Without looking at Figure 1.23, try to see if you can figure out the trend changes by drawing simple trend lines. After you have finished, refer to Figure 1.23 to see if you have drawn the same trend lines as indicated on the chart. There will most likely be a difference in the points chosen in drawing the trend lines. The very fact that you can draw alternate trend lines introduces an element of subjectivity in identification, interpretation, and forecasting. 27.54. Figure 1.22. A basic 4-hourly bar chart of USD CAD. Source: MetaTrader 4. Now go back to Figure 1.22 and try to identify some chart patterns, if you know some. After you have finished, turn to Figure 1.24 to see if you have drawn the same patterns. Were there differences in the chart patterns drawn? Do not worry if there are differences. It is merely a consequence of subjectivity. Subjectivity in pattern recognition diminishes with practice. Here is another example based on the same USD CAD chart. Were you aware of the subtle angular symmetries in the USD CAD? See Figure 1.25. Analysts also pay Figure 1.23 trendline analysis on the 4-hourly USD CAD bar chart. Source: MetaTrader 4. 28.55. Figure 1.24 chart pattern analysis on the 4-hourly USD CAD bar chart. Source: MetaTrader 4. Attention to the angles of ascent and descent in the markets. A novice may not be able to clearly identify chart patterns, trend lines, or angular patterns at the very beginning. But with enough practice, the pattern recognition abilities will gradually improve, becoming more obvious as the skill in reading charts improves. As a consequence, the amount of subjectivity associated with identifying patterns will gradually diminish. Refer to Figure 1.26. Here is the same chart of the USD CAD again, but this time we see the underlying beauty and symmetry of price tempered and forged by the expectation, psychology, biases, and emotions of all market participants. 2. A trained eye. A simple chart of price action is as beautiful as any work of art. 4. Technical analysis is in itself an art. Figure 1.25 angular symmetries on the 4-hourly USD CAD bar chart. Source: MetaTrader 4. 29.56. Figure 1.26 underlying market symmetry on the 4-hourly USD CAD bar chart. Source: MetaTrader 4. 1.6 Basic Assumptions of Technical Analysis. Technical analysis is based on a few fundamental assumptions. The first assumption is that market action, which includes price action, reflects all known information in the markets. The market discounts everything except acts of God. This means that the markets can only discount known information, expectations about known information, expectations about potential events. The market cannot discount unexpected events, unknown information. Market action is representative of the collective trading and investment signs of all market participants, which directs the flow of supply and demand in the markets. This implies that the technical analyst need only refer to the charting of market action, since all known information and expectation about such information has already been discounted by the markets. The actual cause or underlying reason driving demand or supply is irrelevant, as it is only the effect of such action that really matters, that is, prices rising or falling. Some detractors of technical analysis contend that the assumption that all information is absorbed or discounted by the market is flawed. They argue that with the exception of illegal insider trading, price cannot possibly discount and unexpectedly. 57. Large block purchase of shares in the market before it occurs. The detractors are in fact perfectly correct in their contention, except for the fact that the markets do not actually discount unknown information or unexpected events. The market can only react to what is known or expected, which includes insider activity. It does not react to what is unknown or unexpected. Although insider information is non-public, it is still considered to be known information, since the action of insider buying and selling impacts market action and as such represents information in the markets. It may be more realistic to think of the market as in a continuous process of assimilating and adjusting to new market information, rather than an unrealistic, full-blown discounting of all information instantaneously. What are the markets really discounting? It is not merely news, economic releases, or corporate data that the markets are discounting. The assumption is that it discounts everything. This includes information about actual events, expectation about actual events, information about expected events, expectation about expected events, expectation about the possibility of unexpected events. Some also argue that there are many other forms of discounting, like buying the rumor and selling on the fact. They are curious as to what the expectation should be in such a case. Should the expectation be that prices will appreciate once the good news is released, or should the expectation be that prices will fall once the good news is public knowledge, since everyone is in fact selling on good news? How would we know if the market is discounting the rumor itself, expectations about the rumor, expected good or bad news, actual news? In reality, the market discounts all of the above, regardless of what the markets are discounting, be it quantifiable or otherwise. The end result is that price in markets action will ultimately reflect the collective expectation of all participants. Market discounting versus EMH. Efficient market hypothesis. EMH states that for a market to efficiently discount and reflect all information perfectly, all of its participants must act on all information in the same rational manner instantaneously. Does this definition of EMH also apply the basic assumption in technical analysis that the market discounts everything? Detractors of EMH contend that the act of discounting everything is not realistic or is largely impossible. They argue that the problem lies in the action taken. 58. By the participants. Not all participants will react to the same event or information in the same way, and in fact, some participants may act on it in a contrary fashion, that is, shorting the market rather than going long. They also argue that not all of the participants will react at the same time. Some will take preemptive action or act in anticipation of the event, while other participants will act during the actual receipt of the information. There will also be participants who may react long after the information is released. Hence, trying to achieve a certain level of coordinated action for efficient discounting will be virtually impossible. The detractors of EMH also contend that for the markets to discount all information effectively, all participants must have access to that information and must act on it. The market will otherwise be unable to discount or reflect all information effectively. This requirement itself presents a difficult challenge. They argue that it is virtually impossible to get all of its participants to act on all of the information. It is also unrealistic to expect all participants to have access to that information, and even if they do, we cannot expect the participants to be standing by at all times in readiness to act on such information. They further argue that information is never free. It is unrealistic to expect that all participants are able to afford the information, let alone all information. There is a very subtle difference between efficient discounting in EMH and basic market discounting in technical analysis. As far as market discounting in technical analysis is concerned, there is no requirement of perfect efficiency except for the requirement that it discounts everything that becomes known to it, which includes the sum total of all actions taken by its participants, be it in a timely or untimely, rational or irrational fashion. Market action itself represents the ultimate truth and is a direct consequence of the market discounting all information known to it, regardless of whether the information is perfectly efficient or otherwise. The market continues to discount all information and expectations of such information as and when it unfolds and becomes known to the market. The term efficiency, therefore, as far as it applies to the basic assumption in technical analysis, refers to very active discounting all information as it becomes known to the market, regardless of the type, quality, or speed at which it receives the information. For the technical analyst, price is always king and represents the ultimate truth in the market. The markets are never wrong. All market action is considered perfect and efficient under the basic premises of technical analysis. Hence, we see that the term efficient does not carry the same meaning or implications as in the case of EMH. In EMH, efficient has a very specific meaning. The premises upon which EMH are constructed require that all new information be discounted immediately and rationally in order for the market to be perfectly efficient. Efficient under EMH means that the market participants must react 1. Instantaneously to all market information. 2. Rationally to all market information. EMH requires new information in order for prices to change. Bullish news will cause prices to rise and bearish news will drive prices down. Acting rationally means that all participants will make the same logical decision based on the new 3259. Figure 1.27 Efficient market adjusting to new information. Information received instantaneously means acting or responding immediately to new information. Therefore, for the market to efficiently discount or reflect all information, all of its participants must act on all of the information in the same manner instantaneously. See Figure 1.27. EMH contends that since the markets are efficient, there is no point in employing technical analysis, as prices would have already adjusted to the new information and the analyst would have no way of forecasting future action without such information. The reality is that there is discounting in the markets, but it is in no way perfectly efficient. In other words, the markets are at best semi-efficient. This is because it is impossible to have all market participants acting instantaneously and rationally. It is a physical and logistical impossibility in the physical world. A simple hand clap test will prove the point. If a large group of participants was asked to clap in response to a specific single event like the ring of a bell, we would find that there is little chance of observing a perfectly coordinated hand clap across the group once such an event occurred. As we have already discussed earlier, not all participants in the real world would react in exactly the same manner or arrive at the same logical decision based on the new information. Some market participants may have a different view of the markets and view the new information as inconsequential with minor impact on the markets, and may even trade against the new information. Also, there are a large number of strategies that one can employ to trade the markets based on the same information. As a result, when new bullish information is released, participants may enter a long position immediately, enter a short position based on an average upscale trading strategy. 3360. Figure 1.28. A semi-efficient market gradually adjusting to new information. Scale in more positions as the market rises. Scale out positions that may have already been in profit. Wait for prices to become overextended before fading the breakout. Even if the market participants were to act rationally and all make the same logical decisions based on the new information, they may not be able to act on the information instantaneously. They may have received delayed information or were not standing by in readiness to act on the information when it arrived. They may also find it physically impossible to act on all information, especially when information streams in continuously in very quick succession. They may also be unable to afford the cost of such information. As such, the discounting of new information will take place at a slower rate, with a semi-efficient market adjusting gradually to the new information as market participants compete with each other for the best fills. See Figure 1.28. Figure 1.29 is a 5-minute chart of the EUR/USD depicting the markets adjusting to new information, in this case the non-farm payroll and unemployment report. Notice how prices swing back and forth as traders compete with each other in light of the new information. Price finally makes a top at the 61.8% Fibonacci projection, projecting AB from point C level, and begins consolidating. Nevertheless, EMH assumes 3 basic levels of information. 1. The weak form. The weak form of EMH suggests that all current prices have already been fully discounted and, as such, reflect all past price information. Therefore, they cannot impact future prices. The application of technical analysis is therefore pointless and meaningless. 3461. Figure 1.29. A semi-efficient market gradually adjusting to new information. Source: MetaTrader 4. 2. The semi-strong form. The semi-strong form of EMH suggests that all information, once public, is of little use as price would have already adjusted to the new information, making the use of such information unprofitable and pointless. Market participants would have little opportunity to take advantage of such information. This implies that even fundamental analysis is pointless and meaningless. 3. The strong form. The strong form of EMH suggests that all information, regardless of whether public or private, would have been already fully reflected in the current price. Consequently, all forms of analysis and forecasting are pointless and meaningless. Random walk. Closely related to the EMH is the concept of random walk. Random walk suggests that prices move in a purely random manner and that past prices do not have any influence on current price. Current price has no influence on future price. Markovian condition. All information is already incorporated into the current price. This would mean that there is no way whatsoever to forecast future action, and prices are as likely to go up as they are to go down. This renders all form of analysis and forecasting pointless and meaningless. Random walk is in a way related to EMH insofar as current price represents the current state of all information. In random walk, prices do not adjust to any new information, unlike in EMH. Its motion is purely random or stochastic. 3562. Figure 1.30. Random walk, EMH, and their implications. So, are the markets following a random walk? As we already know, the markets are driven by perception and expectation and not by random acts of buying and selling. It is totally inconceivable that all participants invest in the markets in a purely random fashion, completely unencumbered by cost, emotions, psychology, and biases. As we already know, market participants tend to react in a highly predictable manner time and time again. It is the author's opinion that random walk is simply not a true representation of everyday market action. See Figure 1.30. Real-world discounting. In the real world, markets overreact and there is insider activity. With insiders buying and selling, prices adjust to reflect this information. See Figure 1.31. Once the new bullish or bearish information is released, the insiders would in fact be liquidating positions and profit selling off the shares to the public. Figure 1.31 Insider activity impacting market action 36.63. Figure 1.32 Markets overreacting to new information. Figure 1.32 shows the market overreacting to new information. We see the insiders accumulating shares prior to the release of the new information. The public joins in after the information is published. Public participation begins to increase as more participants join in the now obvious rally in prices. This contributes to the herding behavior that finally causes the market to overreact to the new information. This is exactly what the insiders are hoping for in order to extract the greatest amount of profit. Eventually a top is formed as the market runs out of buyers and/or money to invest. The activity subsides only to repeat again. Price versus value. One interesting question that many novices ask is whether the market is discounting price or value. In fact, a more fundamental question to ask would be whether price represents value. If it does, then how do we explain a stock valued at $10 rising to a price of $30 in the absence of any significant changes in its fundamentals? In reality, market action is merely the collective expectations of all its participants. What we are really trading is expectation. It has not very much to do with absolute intrinsic value, but rather its expected value. In short, current price is the result of expectations about future price and value. Market behavior repeats itself. The second assumption or premise of technical analysis is that market behavior has a tendency to repeat itself. This means that past price and chart patterns will provide a reasonable basis for forecasting potential future behavior. The underlying explanation for the repeatability of price and market behavior lies in the fact that market behavior is driven by human psychology, which seldom changes over time. The uses of past patterns to predict futures moves are grounded in the reliability and consistency of human behavior. 37.64. Ironically, most equity valuation modeling and standard economic statistical indicators are based on past or historical information as well. How else are we able to make an intelligent assessment of future outcome without reference to past data? It is human nature to try to infer, extrapolate, generalize, and predict potentially probable future outcomes. The reason for the popularity of classical price and chart patterns lies in the fact that they are essentially visual in nature. Human beings have an innate tendency for pattern recognition, and as such there is a natural inclination to gravitate towards such forms of analysis. The reliability of pattern analysis tends to improve as more market participants start to employ such patterns in their day-to-day trading and forecasting. Unfortunately, there are some challenges to the reliability of using past action as a forecasting tool, some of which are: 1. The preempting effect will slowly erode the reliability of historical patterns as traders start to outbid or outsell each other in anticipation of the approaching technical trigger levels. Preempting is a direct result of the self-fulfilling prophecy. 2. The effect of widespread program trading will affect the reliability of historical pattern trading, as programs are able to trade in ways not easily replicated by manual or human trading. 3. The ever-changing influx of new participants into the markets will slowly affect the reliability of chart and price patterns unfolding in the expected manner. Although human psychology remains largely predictable over the longer term horizon, short-term patterns are sometimes impacted by new participants who have a slightly different approach than the usual participants in that market. The market tends to move in trends. Lastly, from the definitions given of technical analysis, it is generally accepted that the market has a tendency to move in trends. This explains the popularity of trend-based methodologies. Of course, it is not hard to understand the basis for the popularity of trend trading, since trend action affords market participants the greatest profit over the shortest possible duration in the markets. But if we analyze this statement more closely, we understand that the term trend is inconclusive. What actually is a trend? When is a trend, and when does it cease to be one? There have been many attempts to define what a trend is objectively. Successively higher or lower peaks and troughs is one widely accepted method, and is by far the preferred mode of identifying a trend. But then, this begs the next question, which is what constitutes a peak or a trough? Significant containment of price below or above a trend line or sloping moving average may also be deemed a valid way of defining a trend. We shall delve into the specifics of defining trends, consolidations, and other formations in Chapter 5. Although trend following is popular, there are some challenges to using it, some of which are inefficient trade sizing in volatile markets, inefficient profit capture during trends, 38.65, inefficient performance in ranging markets, inefficient adaptation to more volatile trend action, inability to identify trend changes efficiently, possibility of negative slippage in fast-moving markets, possibility of large drawdowns due to the low winning percentages, reduced performance caused by whipsaw action during consolidations, influx of trend-capturing systems produces inefficient fills, ineffective back and forward testing. Finally, it is important to note that a trend in one time frame may be a sideways market in another. 1.74 Basic assumptions in the application of technical analysis. There are 4 underlying premises associated with the application of technical analysis, namely: 1. Price behavior is expected to persist until there is evidence to the contrary. 2. For every bullish indication or interpretation, there exists an equal and opposite bearish indication or interpretation for the same price behavior or phenomena. 3. Extreme bullishness is potentially bearish and extreme bearishness is potentially bullish. 4. A technical tool or indicator has no real significance except for that attributed to it by market participants. The first premise is about preserving the status quo. It should be noted that most technical analysis is based on a set of assumptions. Most assumptions derive from one grand underlying premise, that being the preservation the prevailing price behavior. For example, a trend is expected to persist until there is evidence to the contrary. Hence, a state of persistence is assumed to be the status quo. If a cycle is identified, it is assumed to persist until cyclic failure is clear and obvious. If the market is in consolidation, it is expected to continue to range until a breakout is identified. The second premise is also fairly obvious, not only in relation to technical analysis but also with much of life. For example, an analyst may make a case for rising oil prices as the reason for a rise in the Dow Jones Index, since it is indicative of increasing demand, representing evidence of a recovering economy. The same analyst may also make a case for rising oil prices as the reason for a decline in the Dow Jones Index due to the widely held perception of increasing costs and hence bearish for the economy in general. Another example would be to find the stochastics at an oversold level and conclude that the current uptrend is strong, since it is potentially or implicitly bullish. Alternatively, the stochastics could be at an overbought level, leading to the conclusion that the current uptrend is strong, since an overbought level is regarded as explicitly bullish. 39.66 The third premise above is obvious when using oscillators such as stochastics, RSI, and MACD. A reading of 100% on the stochastics is extremely and explicitly bullish, but it is also regarded as a potentially or implicitly bearish condition since it is at a level where price may generally be regarded as being overextended or exhausted. There is an underlying expectation or assumption that a reversion to the means would eventually take place. Note that this may not always be true. For example, in the case of cumulative type indicators, a breakout above a rising channel is also explicitly bullish, but it is also regarded as implicitly bearish since it also represents a state of overextension or exhaustion in price with respect to the rising channel formation. The fourth premise is specifically about the effects of the self-fulfilling prophecy. It is easy to understand why a largely concerted wave of buying or selling at various points on a price chart may cause a significant reaction in price. This concerted wave of buying or selling will generally be more pronounced if these points are significantly clear and obvious to most market participants using technical analysis. Hence, we generally notice a larger than average penetration bar during trendline breakouts, especially if the trendline is significantly clear and obvious to most traders. This also implies that should an indicator be essentially faulty or illogical in its design, if enough participants risk actual capital based on its signals, it would begin to exhibit a greater level of reliability. The efficacy of technical analysis at various time frames. Technical analysis generally works more efficiently at time frames where there are fewer forms of analysis available. For example, on higher time frames like the daily, weekly, monthly, or yearly charts, fundamental analysis plays a very important role in helping to forecast potential market action. But at very low time frames like the 1-minute charts, fundamental analysis may not be as useful, especially if the stop size is very small. In essence, the smaller the stop size, the more important will be the role of applying technical analysis when trying to forecast very short-term movements in price. This is the main reason why technical analysis is generally more reliable at lower time frames. 1.8 Market participants. Market participants comprise the average investors and traders, financial institutions, commercial and central banks, hedgers, arbitrageurs, brokers, hedge funds, mutual and pension funds, and so on. Here are the 8 main categories of market participants. 1. Retail. 2. Institutional. 3. Speculator. 4. Supply side. 5. Demand side. 6. Professional. 7. Investor. 8. Novice. 40. 67. Figure 1.33 Market participants by way of time spent in the markets. Market participants may also be categorized as discretionary traders, non-discretionary traders. But there are many other ways of categorizing market participants. We can categorize them by the amount of time they spend in the markets or by the methodology that they employ when trading or investing in the markets. Figure 1.33 lists the 5 main groups of market participants by the amount of time they spend in the markets. Figure 1.34 lists the same 5 groups of market participants by way of the methodology that they employ when trading or investing in the markets. Figure 1.34 Market participants by way of trading and investing methodology. 41. 68. Figure 1.35 Popular markets and instruments. Popular markets and instruments. Market participants may trade and invest in either the main markets or instruments that allow access to these markets. These instruments are also referred to as derivatives since they are derived from the main underlying markets. For example, a market participant may participate in gold in several ways. By buying the physical gold itself, main market by buying or selling a futures contract on gold, derivative by buying or selling in Options contract on gold derivative by investing in gold-backed ETF shares derivative by investing and trading gold via contracts for difference CFD derivative. See Figure 1.35 for a visual summary of popular markets and their derivatives. 1.9 Chapter Summary. Technical analysis is the study of market action. It is an extremely popular approach engaging potential market moves as well as identifying past activity in terms of patterns, proportions, and time. It involves the study of price action, volume and open interest action, market breadth, sentiment data, and the flow of funds. It attempts to identify potentially repetitive patterns in the form of chart and bar formations, price cycles, and seasonality, based on the assumption that there is some reliable degree of repeatability associated with these technical formations. We shall delve more deeply into these aspects of technical analysis over the rest of this handbook. 42.69. Chapter 1 Review Questions. 1. What are the challenges to technical analysis? 2. A basic assumption in technical analysis is that the market discounts everything. EMH also requires the discounting of all information. In what ways are they different? 3. Describe how an analyst may resolve conflicting signals or chart patterns. 4. Explain why identifying a trend change is largely a subjective exercise. 5. Is random walk a true reflection of the markets? 6. Describe the 3 levels of discounting new information under EMH. 7. What is a good definition of technical analysis? 8. List as many advantages and disadvantages of using technical analysis as you can. References: Edwards, Robert D., and John McGee. 2007. Technical Analysis of Stock Trends. New York: Amicom. Kirkpatrick, Charles, and Julie Dahlquist. 2007. Technical Analysis, the complete resource for financial market technicians. Upper Saddle River, N.J. Pearson Education Inc. Murphy, John, 1999. Technical Analysis of the Financial Markets. New York: Institute of Finance, NYIF. Pring, Martin J. 2002. Technical Analysis Explained, The Successful Investor's Guide to Spotting Investment Trends and Turning Points. 4th ed. New York: McGraw-Hill.